2026 stock market absolutely will make normal people millionaires, but not because you're gonna find the next Nvidia before everyone else does. And definitely not because you're gonna get rich in 1 year. In fact, I'm gonna tell you this right now. If your plan is to buy the next Microsoft, Meta, Nvidia, or some other AI stock that's gone up 30 times, you're probably setting yourself up to get hurt badly. I understand why people chase that though. You see someone 10x their money, or at least they tell you that. You think, why not me? But here's what nobody tells you. The worst thing that can happen to you as an investor is getting really lucky early. Because luck feels like skill. And when the cycle turns, and it always does, that luck disappears. But if you learn the right process in 2026, then it'll be the year that starts your journey to becoming a multimillionaire. Here's what makes 2026 different. For the last decade, you didn't really need any skill at all to make money in the stock market. Interest rates were close to zero. Liquidity was everywhere. So if you bought large cap tech blindly, you did great. But markets are changing. Volatility is starting to come back. Money isn't free anymore. And stocks are reacting much more aggressively to earnings, guidance, and headlines. So many great companies reported double beats on earnings and still went crashing down. Now, guys, I know I've been saying it for a while now, but market valuations are at all-time highs, even greater than 2000. I don't know when the party will end. The party will end. That kind of environment when the party does end will expose people. It exposes speculators who never learned how to value a business, but they thought they were investors, and there is a difference. It exposes people who only know how to buy momentum without a process. It exposes portfolios built on stories instead of the fundamentals behind them. And when that happens, two types of investors emerge. The ones who get shaken out, I call those speculators, and the ones who quietly build positions while everyone else argues and worries about the headlines. Those are the investors. And that's why 2026 matters. Not because it's gonna hand you some easy opportunities, but because it's gonna force you to decide what kind of investor you actually are. Now, guys, if you thought that this title meant that you're going to have some aha moment in 2026 and have some great way of making money, not the case. It'll never be the case. But I'm going to teach a process here. And for those of you out there who are patient, long-term oriented thinkers, this is the best possible video for you to watch. And here's the part most people are missing. Volatility creates opportunity. When stocks move 5, 10, 20% on earnings, when analysts overreact to guidance, when entire sectors get punished because of one headline, that's when pricing mistakes happen. And pricing mistakes are where long-term wealth is built. Value investors capitalize on the difference between price and value. So 2026 isn't about predicting the economy or guessing what the new Fed chair will do. It's about learning to recognize when a good business is temporarily mispriced. That skill will compound for decades for you. Because once you know how to read financial statements, understand what a return on capital is, and make reasonable assumptions about growth, once you're able to compare that price to intrinsic value, you stop reacting to the noise. You start seeing opportunity where other people see danger. That's what I'm here to teach you as someone with almost 30 years of investing experience. And by the way, 30 years means nothing. But the point is, I've learned from multiple crashes, multiple bull markets, from my own mistakes. But I still know people who've been in the market for 40 or 50 years who have no understanding of what I'm talking about right here in this video. Luckily, you will. Here's the uncomfortable truth. Most people who own stocks have no idea what they actually own. They own a ticker. They know that they sit there and say, I own this ticker, goes up and down. They know the story. Well, AI is changing the world, therefore I got to own this company. Maybe they know the product. Well, NVIDIA makes GPUs and blah, 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 blah. But they don't know the business. They don't know the fundamentals. And if you don't understand the business, you're not investing. You're speculating. When you buy a stock, you're not buying a line on the chart. You're buying future cash flows. Our 8 pillars and key metrics allow you to do exactly that, to assess the balance sheet, the profit margin a company actually earns, and the other fundamentals from there. At that point, price versus value is what changed everything for me. It really clicked. Price is what the market shows you every second. That's the offer for you to buy or sell your shares. Value is what the business is actually worth based on reasonable future assumptions. Those two numbers are rarely exactly the same. Sometimes price is above value, sometimes price is below value. This is where wealth is built. You need to understand what you're buying and refuse to overpay. But guys, You must pay more than what people usually think for great companies. You don't pay the same multiple of earnings that a company that's growing 20% a year versus a company growing 2% a year. Intrinsic value on those two companies are very, very different. Understanding value is step one. But here's where the best investors separate themselves. Your Warren Buffetts, your Charlie Mungers. They don't just estimate value, they demand a margin of safety. So what does that mean? Well, guys, the analogy I love that Buffett gives is when a bridge maker builds a bridge and they say, hey, build this bridge to support a 10,000 pound train. You know what they do? They build one to support a 20,000 pound train. That's margin of safety. Apply that exact same thing to companies. If you think a company is worth $100 per share, you don't buy it at 98 or 100. You might wait until 80, 75, 70, whatever it is, that's your margin of safety. Because guess what? We need a margin of safety because the future is unknown and we're humans and we make mistakes. Growth might slow. The CEO might come out and all of a sudden he went from everybody thinking he was a left-wing guy to a right-wing guy, and all of a sudden the leftists of the world hate him. That's the story of Tesla. Margins might compress. A recession might hit. A COVID thing might hit. A margin of safety helps protect you from your own mistakes. That's so incredibly powerful. But the goal isn't to be right every time. The goal is to be protected when you're wrong. And this is where 2026 becomes such an opportunity. In volatile markets, prices swing much more than business value. A company might report slightly lower guidance, the stock drops 15%. Did the long-term earning power really fall 15%? Usually not. And if it did, it probably wasn't a very stable company to begin with. So what I want to show you next is a real example of a company I believe has traded at a margin of safety and the process I use to determine that. These are the exact conversations we have all the time during our community exclusive live streams that we have every 2 weeks. Southwest Airlines is the kind of company most investors ignore, and that's exactly why it's interesting. It's a simple domestic airline that ran profitable for 47 straight years before COVID. The business model is straightforward. One aircraft type, efficient routes, strong brand loyalty, and a history of operational discipline through things like hedging oil properly. But after margin pressure, rising costs, and some recent operational issues, the stock has been beaten down since COVID. After reporting earnings recently, the stock has risen, and it's already up significantly from where I started buying. If Southwest can return to a normalized profitability over the next few years, buying it at today's level could still be an incredible opportunity, even though it's up 60% in the last year or so. And that's what I'm going to show you on our most used tool by members of Everything Money, our stock analyzer tool. Remember, don't ever buy a company because I or anybody in the world owns it. We're here to teach a process. And even if Warren Buffett owns a company, he's buying it for different reasons than you would, and he knows different things than you do. So it's important here to understand that this video is teaching a process, and you apply this process to companies that you know and understand. Let's go to the board and start breaking down this company. So guys, with Southwest, like I said, it's had a big run up lately. If you look in the last 6 months, it's up 56%. In the last 3 months, 52%. Year to date, and it's only February 20, whatever, it's up 23%. Now, here's what I'm talking about with my thesis. A well-run company with a temporary problem. Now, granted, they compounded those problems, but here's what I mean. Before COVID, their profit margin was 10 to 15% consistently. You'll be able to tell this here. Their profit margin over the last 10 years was an average of 4.84, and the last 5 years was 1.43. Guys, go to the numbers right here. Last year they did 1.38. Let's go to the financials. Before COVID, 2015, 20 billion in revenue, 2.18 billion in profit. 2016, 20.3 and 2.18 billion in profit. 2017, 21 billion in revenue, 3.3 billion in profit. It's consistently 10 to 15%. That is my thesis here. Well-run company, temporary problems, as they fix them, the profit margin should come along with it. Very simple. I don't need to go over all of these metrics to sit there and explain my thesis. It's a very simple thesis. With that said, we will go over all of these metrics in other videos, or a large chunk of them. It's very important to understand these. The good news for you is I have a free cheat sheet that will explain all of these metrics to you. It'll be emailed to you. You'll have it right at your fingertips. And if you're serious about investing, if you're serious about becoming an investor, you need to download this cheat sheet. It gets downloaded hundreds and hundreds of times. each video. Click the link below. It'll be emailed to you. You'll have it at your fingertips so we can speak the same language. And trust me, if you ask any value investor out there, are these important metrics? Yes, they might weight them differently, but nobody's going to sit there and say, oh, that's stupid. They'll sit there and say, yes, these are important. It's a great understanding of a company. So I don't want you feeling overwhelmed. And if you do, I get it. I was overwhelmed at one point. Warren Buffett was overwhelmed at one point. We're here to break this down as simply as possible. So go download that cheat sheet right away. Now, we talk about 8 pillars a lot. But in a company like this, I couldn't care less what the 8 pillars are. 4 checks, 4 X's. But the ratios are based on a 1.48% profit margin. Well, of course they're going to be junk. Don't care about that. Long-term debt. Well, the cash flow of the last 5 years has been negative. Of course, this is going to be an X. I look at this and the ROIC. Airlines have very low ROICs. In the last 10 years, they averaged 7.3%. The last 5 years, 0.59, which means the average is almost 15%. Before 10-year mark, before the 5-year mark, it was over 15%. This is a high-quality business. It's an airline, which is difficult. That always worries me. But the point is, I'm not caring about these 8 pillars. Let's see what analysts think. Well, look at analysts, guys. $270 per share this year, growing to $650. If you've set a 20 multiple to this, that's $130 stock in 2029. Now, doesn't mean it's going to actually happen, but the point is, analysts are optimistic. And revenue growth, 7.5, 5.5, 5.5, 7.5. Pretty solid revenue growth for an airline. Travel will continue to get better. In addition, they're starting to charge for extra things. Southwest is becoming more of, we're going to charge you for the things other airlines charge you for, but we're going to stay efficient by properly hedging our fuel, by keeping the same airplanes and keeping smart routes. That's what I love about this airline. Now, we have a story. We have numbers. We put them together in the stock analyzer tool. Let's pull up the last time I did Southwest. You can see my assumptions. Guys, if you have our software, you make your own assumptions. I'm just here to show you what I assume for this company going forward on a 10-year analysis, okay? So first off, revenue growth, I did 3, 5, and 7. The next 3 or 4 years was averaging around 6 or 7, so I'm comfortable being conservative. Profit margin, 8, 11, and 14. I didn't go crazy and show 15 in the middle. I still sat there and said, on the low side, if they do 8%, okay, pretty good. Now, what PE would I assign to Southwest 10 years from now? Well, what I always tell people is for all companies, start at 15 or 16, but go higher for good companies, lower for bad companies. I do consider Southwest a great company. It's in a bad industry. Kind of weighs it a little bit lower, but I put 16, 19, and 22 because they had high returns on capital before COVID hit. So I really think it's a premium business, and I'm putting 16, 19, and 22. And finally, what desired return do I have? For you guys, when you put it in here in your own stock analyzer tool, put in a higher than market number. Because if you're just going to make the market, just buy a low-cost ETF. This gives me margin of safety if I put it higher. Right now, there's no margin of safety. I'm okay with that just to determine the value. Hope is not a plan. I used to buy stocks hoping that they would go up. But hope doesn't protect you when the market turns. Hope doesn't help you sleep better at night. Hope it doesn't decrease your fear. I had to learn how to build a real strategy, one that makes sure that I personally never go to zero. Now, every investment I make is based on numbers, not hype. This is why I built Everything Money. It was built for me. I wanted the tools that gave me clarity, took the fear out of investing, and helped me make better decisions that helped me sleep better. People saw me using them on YouTube and said, Paul, can you give us that software? And I said, well, I can't because it's mine right now, but I can create it. And so I did, and a real community was born. Real people sharing ideas, live chats, live streams, and tools that help beat 99% of investors. I still use these tools like the stock analyzer every single day. Stop guessing, start learning. Click the link below, try our trial, $7 for 7 days, and see how confidence will replace your fear. Guys, I hit the analyze button. Boom. This is why I like the company. Low price of 66, high price of 195, middle price of 120. Very high return assumptions. Guys, I don't know if I'm right on Southwest, but the point is, if I have 30 or 40 companies that have these kind of potential returns, I'm going to do quite well. Now, one thing I want to do is I want to transition to a key strategy that you can bring into value investing to generate some significant income. People typically hear about options and think leverage, gambling, and for the most part, yes, that is a very, very common way to speculate and lose a lot of money quickly. But used correctly, options can be a massive tool to build wealth. Let's take Southwest, for example. If you like Southwest, that's currently selling for $50 a share, but you like it at $45, you can go out a month from now and sell a cash secured put. What this allows you to do is it allows you to give somebody the option to force you to buy Southwest at $45, and they're going to pay you for it. So what'd you get? You got money today to buy Southwest at a 10% discount. How much money? Well, we go to puts here. We go to March 20th, $45, 71 cents per share. If I did this over and over and never got my shares, I'd be generating a 23% annualized return on that money doing a comparable thing. That's what I love about cash secured puts. It allows me to be patient, be paid to wait to buy companies I want at lower prices. That is not some sort of typo or mistake. I'm being paid to buy companies I want at lower prices. If the stock falls below 45 bucks, I buy it for 45, I keep my 71 cents. If it stays above 45, I just keep my 71 cents and get no stocks. Now, same thing. If you own Southwest, you can do what's called a covered call, which allows you to sell somebody the option to buy the stock from you, so you're forced to sell it at a price in the future. These are things we teach in our software through courses that we've set up and through the community of like-minded investors. When options are used properly, they have a ton of benefits. You get paid to buy at lower prices, you generate income while you hold stocks, and additionally, it keeps you engaged while you wait for your thesis to play out. That is beyond powerful. Now here's the part nobody puts in the thumbnail. Millionaires are rarely created by one stock. They are created by habits. The people who become wealthy over 10, 20, or 30 years are the ones who stay invested at all times. They dollar cost average consistently, and they stick to a process that works. They don't swing for home runs. They let the home runs happen because they get to the base enough. They stay at the plate as long as possible. They focus on compounding over long periods of time. They get their singles and their doubles consistently, and sometimes they hit a home run. They're going to own 15, 20, 30, whatever it is, good businesses over time that they buy at the right price. They use options conservatively to enhance returns, and they let time do the heavy lifting. And most importantly, they don't panic during volatility. The story I always tell from 2007 and 8 are the friends of mine who said, if the market falls in half, we're going to buy more. Then it fell in half, and suddenly their plan disappeared. The story changed. I want to make sure that you use 2026 to build a process that will lay the foundation for you to build wealth over coming decades, so that you don't end up in a similar scenario to them when the markets do fall. So to wrap this up, the stock market can make you a millionaire if you use it to build skill. If you learn how to value a business, if you demand a margin of safety, and you're willing to watch paint dry, stock market millionaires are going to be made from that. They're not going to be made in one single year. They're made by what you practice year in and year out. Every great athlete talks about their consistency. So if you commit to the right habits now, the next few decades can look very different. So if you enjoyed this video and want to see an entire breakdown of my options process, I put together a detailed guide exactly for that purpose. So click the video on the screen, check it out. Thank you for your time.